Think about two people, Alex and Sarah. Both have $10,000 to invest. Both want to retire early. But fast forward 10 years, and Sarah's account has tripled, while Alex is back at zero, wondering where it all went wrong. Is Sarah a genius? Does she have a secret crystal ball? Probably not. The truth is, the difference between smart and dumb investing isn't about IQ, it's about behavior. Today, we're breaking down the habits that build fortunes versus the mistakes that burn them. By the end of this, you'll know exactly which side of the line you're standing on. Let's start with what most people do when they first enter the market. I call this the casino mindset. The dumb strategy usually starts with a hot tip. Maybe it's a friend at a barbecue, a viral TikTok, or a headline screaming about a 1,000% gain in a meme coin. This investor feels the FOMO, the fear of missing out. They buy in when the price is at an all-time high because everyone else is talking about it. But here is the trap. They have no exit plan. When the market inevitably dips, they panic. They see red on their screen, their heart rate spikes. They sell at the bottom to save what's left. They buy high, sell low, and repeat the cycle until their capital is gone. This isn't investing, it's expensive gambling. Now, let's look at the smart strategy. If the dumb strategy is a high-speed car chase, the smart strategy is watching paint dry. And in the world of finance, boring is beautiful. Smart investors don't look for the next big thing. They look for systems. They use a strategy called dollar cost averaging. They invest the same amount every month, regardless of whether the market is up or down. When the market crashes, they see it as a clearance sale. They don't check their portfolio every 5 minutes because they aren't investing for next week. They're investing for next decade. Their secret weapon isn't a complex algorithm. It's patience and the iron rule of compounding. There's a massive difference in how these two groups handle risk. The dumb strategy loves the all-in move. They find one stock they believe in and put their entire life savings into it. It feels brave, but it's actually a math error. If that one company fails, you are 100% wiped out. The smart strategy uses diversification. They own a slice of the entire economy, hundreds or thousands of companies through index funds or ETFs. They know that while one company might go bankrupt, the entire global market is unlikely to go to zero. They don't try to find the needle in the haystack. They just buy the whole haystack. Here is something most people overlook: the silent killer. Dumb investors often chase active management. They pay high fees to fund managers or trade constantly, racking up commissions and taxes. They don't realize that a 2% fee can eat up nearly half of their potential wealth over 30 years. Smart investors are obsessed with low costs. They prefer low-fee index funds. They understand that every dollar paid in fees is a dollar that isn't compounding for them. They know they can't control the market, but they can control what they pay to participate in it. The biggest hurdle isn't the math, it's the ego. Dumb investors hate being wrong. If a stock they bought drops, they hold on to it for years, hoping to break even just so they don't have to admit they made a mistake. This is called loss aversion. Smart investors are emotionally detached. They follow a plan. If an investment no longer fits their thesis, they cut it. They don't marry their stocks. They realize that the market doesn't care about their feelings or their break-even point. So where do you stand? If you've been chasing tips and checking your apps every hour, don't worry. Most of us start there. But the path to true wealth is moving from the casino mindset to the system mindset. Investing shouldn't be your personality or your hobby. It should be a background process that runs while you live your life. Sarah didn't get rich because she was lucky. She got rich because she was disciplined when Alex was emotional. If you want to start building that smart system today, I've put together a checklist of the top 3 low-cost index funds to look at. Would you like me to break down how to set up your first automated investment plan?